Hi guys, hope you guys are good. Hope you guys had a good weekend. Um, so in this video, we'll be doing a weekly overview on GBPUSD. Probably also show you guys what I'm seeing on the DXY, seeing that this week has a lot of high volatility news coming for the dollar, and for some reason, I tend to really enjoy these conditions. Um, with CPI as well. CPI, I really love a CPI week, especially when CPI drops. Um, yeah, but with that being said, we'll run through this video. Like I said, we're going to be doing a weekly overview on GBPUSD, uh, going through what I'm anticipating. I'm going to also show you guys a few concepts as well. And yeah, with that being said, I also did post this analysis earlier on, potential sell idea. I'll also explain why I'm seeing a potential sell idea off of these 1 hour buy stops. And at the moment, we still haven't taken those buy stops, but yeah, we'll run through all of that. We'll also clear up a few concepts as well as we do the analysis, right? So firstly, let's go on to DXY, just to give you guys context on what I'm seeing on the DXY. This has already been analyzed. So currently we are in a monthly fair value gap, right? In which we rebalance that monthly fair value gap, hence the reaction, right? We got this reaction all the way down to take these sell stops. We also tapped into the bullish order block over here. And on a weekly perspective, we are in that. We filled this weekly fair value gap. You'll see that we filled it and then we wicked it, and when we closed above it in these two occasions over here, and we also tapped into this breaker block. All right. Um, so all of those are just confluences for the idea that we may continue higher. My dollar perspective is to reach these relatively equal highs over here, but I do stand to be corrected, of course, right? But with that being said, let's go on to GBPUSD, right? So on GBPUSD, we can see that on a daily time frame perspective at this point over here, that's when we switch bearish. We were bullish all the time. We switched bearish, and the anticipation was then to reach into premium prices, being this point over here, premium buy stops. So we look for premium PDA such as fair value gaps and liquidity. All right. So we reached into that premium buy stops. I just want to run through you guys um, based on how I analyze the market in terms of draws, how the market moves from external liquidity towards internal and from internal towards external, because I tend to say this a lot. ICT traders, when it comes to ICT traders, there's this misconception that liquidity only exists at highs and lows, right? Liquidity also exists in terms of internal range liquidity, such as fair value gaps and order blocks. I'll show you that now. So you'll see we get here. This is our extreme point high, intermediate term high. That's our intermediate term low. The moment price takes this out, it gives us an idea that it's a market structure shift, giving us an idea that now we may be retracing, right? So how does the market move? Although this is a market structure shift, liquidity exists over there in terms of external range liquidity. So then the draw is towards internal range liquidity. You'll see that the market then tapped into a daily fair value gap. We rebalanced that fair value gap completely, and then the draw became these relatively equal highs, also termed as engineered liquidity, which is also considered as external range liquidity, right? So we target that. After external range liquidity, what happens? The market goes again to target this fair value gap, which exists as internal range liquidity. There's multiple ranges of liquidity at this point. You can see that we also have this order block here as well, right? As more confluence, bullish order block aligned with the fair value gap. Both of them are considered as internal range liquidity. From there, our target is external, right? So the idea is to continue following the market like this until you reach your premium buy stops, right? Because that's where the market is likely going to be drawing to due to the fact that there's a large amount of liquidity at that point. So the market continues doing this. You take external. What happens is you draw into internal, right? Internal fair value gap holds internal liquidity. Again, external, right? Once external is taken, anticipate to move into internal liquidity. So you're looking at a fair value gap or you're looking at a order block, right? And if it so happens that both of them are aligned, right, even more confluence for you to consider buys at that point to target again external range liquidity, right? Nope. It is getting a bit cluttered now, but I'm sure you get the idea. You take external, price goes towards internal. From internal, you buying at that point to target the high over there, which exists as external range liquidity. After that, you'll potentially see on the smaller time frames a draw lower into internal range liquidity. At this point, you have a fair value gap aligned with a bullish order block. At that point, you want to be buying to target external range liquidity, and this continues. You take external, right? And you also see to your left, you're doing the same thing. You're taking external range liquidity over there, right? And then internal, and then the market continues higher. You target internal range liquidity, this order block over here. The market reaches the order block, and you get a reaction into internal again, right? Because you took external. But in this instance, you can see you have a fair value gap and an order block, all right? So of course, on your smaller time frames, you will be confirming, looking to see which of the two is the market going to be reacting off of. At this point, price goes all the way down into discount of this low to that high, right? Reaches all the way down into the discount PDA being the order block. You have more confidence in buying to target external range liquidity. So like I said, you're going to continuously be doing this until you reach that point over there because that's your optimum higher time frame draw on liquidity. All right. So external range gets taken. What happens then? You draw into a fair value gap, right? That exists as your internal range liquidity. After that, you're targeting external, right? And then you reach your objective. At this point, you now want to be considering the opposite to be happening, right? You want to now see the market give you an idea. Let me just delete and clear all of these things out. Hope you guys understand that. Now we're going to be using the same concept, but in a bearish perspective, right? External range liquidity gets taken. What is your draw now? But at this point, you're now anticipating that these lows will get taken out in form of a market structure shift to give you an idea that the market is now switching bearish, right? Because you reached your premium PD array, right? And now you've established a intermediate term high. So now we'll do this a lot quicker. So market structure shift occurs, all right? That also exists as external range liquidity. The market then goes all the way into premium prices in which it reacts to a premium PD array being the order block. You do not anticipate price to go higher than that. Why? Why do you think that's the case? It's the case due to the fact that at this point, order pairing occurs where they order pair these buy stops with their sell order. So at that point, it becomes a high resistance liquidity zone. So you're considering all the PDAs from that high to that low, hence the order block. You'll see again, more liquidity gets taken here in terms of buy stops. Order pairing occurs again. This point over here becomes a high resistance liquidity zone. So after that internal range liquidity, the market continues lower. The target these relatively equal lows that exist as external range liquidity, right? And what is happening at this point as well is you're getting a support region is forming here. Support region is forming at this point as to engineer liquidity to the downside so that the market can absorb all of that. Because what's happening on the upside, on this side, is high resistance liquidity zones are being formed. After sell stops get taken, external range, you draw into internal, in which the market reaches premium prices where it taps into the order block, right? You also see that fair value gap there is filled, right? So internal range liquidity is filled. The market is then yet to target external range. Accumulates at this point, and that accumulation of orders is just building up more liquidity for the market to order pair against, establish high resistance liquidity zone, and move away from that point, right? So you have all of that internal range liquidity, which is taken between that high and that low. The draw is lower towards sell stops, right? So you've established that all of these points are high resistance liquidity zones, and you don't want the market, or you don't see the market going all the way up there, right? There's unlikelihood that the market would then want to target all of that. So what do you have? Market takes sell stops again, draws towards internal range liquidity being the daily order block. And that's where we're currently at now, right? So you have our daily order block over there, right? And we are in internal range liquidity. What happens within this order block as well is the market goes back up there as to retest it to take more liquidity, right? Or to order pair, right? Order pairing occurs over there. But you'll notice before that happens, the market makes a high, makes a low, goes all the way up into the order block. The market is then anticipated to push towards external range liquidity, which exists at this point over here. So it doesn't go all the way down there, it takes this low over here. And now you know that liquidity has been taken, right? The market decides to go all the way up there again as to target external range liquidity and an internal range, right? Being that high to that low. So once you're all the way up here, what's the next draw? You're in internal range liquidity. The draw is to target external range liquidity in terms of lows, right? So at a higher time frame perspective, or being the daily time frame, of course, I am seeing these relatively equal lows here that exist as engineered liquidity, right? And this is my higher time frame draw on liquidity. So things such as relatively equal lows, trend line liquidity, all of these points are very strong points of liquidity that the market will draw to. They are external ranges of liquidity, right? So at this point, like I said, we've established that that may be our high resistance liquidity zone. And what we'd want to see is the market then having to draw towards the engineered liquidity. Same way the market engineered liquidity using a support here. At this point, the market is engineering liquidity using these relatively equal lows by using um, retail traders' patterns. So then what happens is we're anticipating that absorption of orders, right? Let's go a time frame lower to the just fix all of that. I think it should be fine. All right. We have okay, let's go into current price action. We've established that at this point, this is a high resistance liquidity zone. Over there, right? That's our high resistance liquidity zone due to the fact that order pairing occurred over there. They entered their sell order. So we don't anticipate price having to go higher than that point over there. It may occur. And if it does, of course, we will react accordingly. But at the moment, I do not see price wanting to go all the way up there due to the fact that we took these buy stops. And we're accumulating a lot of liquidity, right? In terms of engineered liquidity. Look at the relatively equal lows, right? This is continually this is the market continuously engineering liquidity, right? By enticing us into continuing price higher. We have all these perfect trend lines, all of the liquidity. You can imagine the amounts of liquidity that exist at these lows. And eventually, what will occur is the market will absorb all of that liquidity, right? You can see here, after we establish the high resistance liquidity zone, you form a pennant pattern, right? It's another tactic that IPDA, being the interbank price delivery algorithm, does to manipulate us. And manipulation of orders is essentially called engineered liquidity, where it uses patterns such as trend lines, support and resistance, all of those sorts of things, to entice us into buying or manipulate us into entering the wrong direction, right? By using patterns. So you'll see here again, you have a pennant pattern at a high resistance liquidity zone. We're anticipating that price would break out, right? That's what the book teaches us. That's what the books teaches us, but that doesn't occur. What happens is you absorb all of that liquidity. So at this point, we understand that we absorbed all of this engineered liquidity, right? So we absorb all of that. These points over here are established as high resistance liquidity zones. These are the points they were selling against us, who we were selling against the retail traders who were buying, right? They continuously sold against us until the point where all of that absorption of orders occurs, right? So we have all of that as well. On the higher time frame perspective, all of that exists as engineered liquidity that is yet to be absorbed, right? So let's go on to the hour. We look at that, move a bit faster now. So we can see that occurs. We move lower. We tap into this order block over here. So what happened is we took external range liquidity. The draw is then towards internal, right? So we tap into this H1 order block. Mm, So that. So we tap into our H1 order block down here. Take an external range liquidity that draws towards internal range liquidity, in which the market taps into this order block over here. But before tapping into that, can you see that we engineer liquidity? Why was this order block very important? Due to the fact that the same way in this instance, this order block was very important due to the fact that it had a liquidity void, right, which was filled. And essentially what liquidity voids are inefficiencies in price action, where you just deliver rapidly in one direction, right? So the market comes back to clear out that efficiency to fill that void, right? And the same thing happened here. You had a large push in just sell side delivery, hence this order block was very important, right? Therefore, that was the extreme order block in which we'd want to see price react off of. But can you see that price engineers liquidity first by using a resistance, but eventually comes back and absorbs all of that liquidity. So we're looking at that in terms of buy stops. So buy stops got taken at this point. After taking buy stops, the market moved all the way down to take all of these sell stops, right? Can see that you have relatively equal lows at this point. It's another way of engineering liquidity because it formulates a support and people buy against it. Can you see that? Only for the market to absorb it. Their real orders put into this point. They use the liquidity, the sell stops. They auto pair the sell stops with their buy order. Hence, the market continues higher. We've established that these are high resistance liquidity zones, but at this point, there's still these relatively equal highs. You can see it's currently generating that now. So we already reacted off of that and off of that. At this point, what I'd want to see is for the market, due to the fact that there's still this strong uh, resistance point over here, I'd like to see the market absorb this liquidity, right? Being that high over there, absorb the liquidity to sell against it to formulate a high resistance liquidity zone. And then the draws, of course, would be all of those points we're looking at, the engineered liquidity to the downside. But with that being said, kind regards, the architect.